Hi, Matteo. Thank you so much for coming to the Investor Talk series. How's it going?
Good, Max. Good to be here. Thank you so much for inviting me. I'm excited for this talk.
Thank you so much for coming. So, why we do the Investor Talk? As we aim to build a very strong library for founders. So, founders they can go and see how investors, what is the logic behind investing in venture capital? Many founders they go and they approach the venture capital, but they have no idea how it works behind. So, it's better for them to know actually what investors think about how do they the way how do they deploy money. So it's easier for them to prepare themselves before having the first chat or the first interaction or any call. As we start, would you like to give a short intro to who you are?
Absolutely. My name is Matteo Costa. I'm originally from Italy, like Max, but I've been living in the States for the past 6 years, and I've been out of my country for the past 10. Um, I started in consulting, but most recently, I was an entrepreneur myself when I was in business school. But most recently, I've worked in corporate media in business development and marketing capacity. And in the past 2 years, I approached the world of angel investing. So I've made a few investments again in the past couple of years. Also because in my corporate job, I've always been working, interacting, partnering with startups, running the internal accelerator. So the world of startups and innovation has always been close to me. But it wasn't until 2 years ago that I decided to kind of like make an active step into this ecosystem. And we can talk about the reasons why, but basically support early stage founders with with their missions and endeavors when they align with mine.
Thank you, Matteo. Me, an angel, investing in startup is not an easy job at all. It's very, very risky. I describe like the highest risk you take in life if you want to invest in, give it the money to pre-seed and seed stage startups and other thing. Stock market compare is nothing. In which sector, stage, and geography you prefer deploy your money?
So far, I have invested in early stage companies. The rounds that they've been in, well, to clarify, I've invested in two companies directly, and in another case in a venture capital fund. But all the companies in the portfolio are early stage, as in pre-seed. Maybe there's one or two in the seed stage in the fund, but pretty early stage. So after the family, friends, and full round. Um, I found myself gravitating towards companies that I call them, like, I label them as having a positive impact on society. So the sectors that I've invested in are food tech or alternative food, sustainability, and mental health and psychedelics, which is the venture capital fund. Just because they align more with my values, I'm not looking necessarily at companies that can scale or grow like extremely fast. I'm more focused on having a positive mission. And then geographically is, I would say, across Europe, across the Atlantic, Europe and United States. So the two companies that I had direct investments in are based out of Europe, and the venture capital fund is based out of the US. So I'm not so picky on the geography. It's more important you know the companies and the sectors, and again, if they align with my investment thesis.
I mean, in terms you invest directly and through venture capital funds. What's your thesis behind? Is the same one?
Um, well, no, I mean, the biggest difference is that direct investments is putting all the money. So here's my philosophy. I am of the idea of making more, as many investments as possible, of course, in line with your financial situation, financial means. The reason being, to your earlier point, is that, like, investing in startups, being an angel investor is incredibly risky, right? Like, so the stats are 30% fail, 30% don't return the money, 30% maybe one or two, and then 1 out of 10 statistically maybe is returning 10x, right? So you need to do enough of those to diversify your portfolio. And if you have a lot of direct investments, that can add up. Companies, and I can talk about how I did it, but companies tend to require checks of like 10, 20, 50,000, depending on how many investors they want to have on the cap table. The benefit of investing in a venture capital is that you have an intrinsic diversification. They already diversified the investments for you. Of course, some of the funds are specialized in a specific sector, in a specific stage, but at least it's a combination of companies. So for me, the combination, the mix of like direct investments with smaller check sizes and a bigger check in a VC keeps this idea of like diversifying your portfolio.
I mean, if you want to disclose, of course, what's your average check? I mean, how much you like to invest, for example, directly, taking a lot of risk and maybe pull inside a VC where the risk is mitigated for sure.
So I'm fine to share, and this goes back to what I was mentioning. The way I approach angel investing is through this program, and I know you interview the organizer of the program,
Yeah.
which I highly recommend to people who wants to get close to the world of angel investing if they don't know how to start. Like I didn't. Basically, this program that was born out of Seattle and then branched out into European or a transatlantic version allows for people to write smaller check sizes in the amount of like 5,000, but by pooling a group of investors together, usually 20 plus, then the check becomes meaningful for the company. So you pool the money into an SPV and you invest as a single entity. So there's one investor on the cap table, but you are a group of investors giving a check of 5,000 each time. So as you can see, you can make, if you make 10 of those, you have 10 different investments versus a single check of 50 or 2 of 25, right? So there's a diversification. The check that I wrote for the fund is bigger, but as I mentioned, like there's an intrinsic diversification with the fund. So I try to keep my check where possible. My check sizes in direct investment small, and then potentially bigger for funds. The last thing that I'll mention that I didn't say, the other difference is that direct investments, you have more of a say. Like you can you pick the direct company and you can do your due diligence. There's more work. The venture fund, I wouldn't call it a passive investment, but there's a lot less labor and work on your end to screen, deal flow, due diligence for the company. So you're delegating that responsibility to someone else.
Yeah, that's for sure. I mean, when you invest, let's say when you invest directly to startups in very early stage, pre-seed, seed stage, what you are looking for? So what you evaluate the most? The idea, the team, the product itself, the service?
So it's funny that you ask, because in my experience as a up and coming or not experienced, an experienced angel investor, I was pondering on the same thing at the beginning. And what I found myself aligning with over time, over these experiences, is the team more than the other things. And there is, like this famous quote from Techstars that says, team, 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 product and market. There's even a book by these two authors called Benjamin Hardy and Dan Sullivan that is called Who, Not How. It's a philosophy, but what I found myself gravitating towards is the idea that if you have a winning team, the product and the market are secondary or relatively important, or in other words, they are able to pivot when the time or when the opportunity comes, right? Like, and so there is this idea that I kind of like got closer to of founder market fit over product market fit. So if you have like an attractive founder, then obviously you also need to have like an attractive market and a good product, but you're betting more on the capacity and the skill set of the founder of the founding team to make it happen, and even in the future being able to make changes when the needs arise, more than finding the most amazing product that if you don't build a moat or if the market changes, then you're kind of like left with that risk.
I mean, the very beginning founders, they really wait a lot. They are almost everything and they do almost everything. So you're perfectly right.
And this is, if I may add, this is particularly true for early stage companies. It's really hard. When people say product market fit, it's really hard in the very early stages at the beginning. Some of these companies might not even have, if you're willing to take that risk, might not even have customers, right? It might be, I don't want to say an idea, but There's very, very early traction. Maybe there's customer feedback, which for me is very, very important. It drives kind of like product market fit. Like you need to prove that the market is willing to buy and pay for your product and service. But then again, it goes back to the founders to make it happen before even coming up with a full-fledged or even MVP kind of minimum viable product type of solution. So team is very important in the beginning.
Are you confident to invest totally 100% remotely? Video calls without never ever meeting any founder.
Well, this is what I've done so far, so I'm kind of like biased, but and I started doing this after the pandemic, so I don't even have like kind of like frame of reference of what it could have been before. So that's why my point of view is maybe like biased. But I do believe that in this day and age, technology and virtual conferencing and virtual meetings do allow for this type of interactions. I'm still a firm believer that in-person interactions are the best, but at the same time, if the opportunity is good enough and you can't meet the founder in person, you still should go for it versus like passing on it. What you could do, which I have done in one or two cases, is maybe being able to meet the founders after you have invested. If you can't before, building rapport over time, which I have done in the second investment, direct investment. I was the lead investor, and I'm happy to flesh that out because it's not the term lead investor that people are familiar with. But I was basically the SPV organizer, and I've been the one in charge of like the liaison between the winning company and the rest of the investors. So I build that kind of relationship, and then it's important to then meet in person or meet frequently. But short answer is that it's possible to do this remotely. If you can meet in person, even better.
Let's articulate a bit more in this case, it's an SPV and all the other investors in it. But when it comes to after investing, uh, you like to get in touch with the funders, get in some kind of report, for example, any 3 months?
Yes. So the idea, and it's only been, I think, a year at this point since that investment. But I like to keep in touch. It's a fine balance. Like you don't want to be overwhelming for the founders, right? Like you don't want to be constantly in touch and asking for questions or updates, but at the same time you want to be on top of it. And it's not really about kind of like micromanaging or monitoring the founder, is that you want to be of best service because it's a win-win relationship. When they win, you win, right? And so it's not just about the money, but it's also the brain and human capital that you can put into that. And especially if you have a network of other investors that invested in that, they can come in and provide support and service and help where it's needed. So just to give a practical example, maybe at the beginning, it's a lot about building a sales pipeline, right? And so if you have a network of investors that can help you with contacts, with introductions, with their own network to bring you clients and start the conversations, that is of great help. So this is the type of relationship that I'm trying to build over time with the founders, with the founder of this second company that I invested in, and be of the best service to them, whether it's sales or anything else. I don't want to keep in regular touch just for the sake of it, but I would like to understand what are the areas that they need most help in and how we can de-risk their the investments going forward.
Correct. In terms of involvement, let's say funders they need help, right? There are funders very very with little experience when it comes to run a company. Okay, you have a great idea, you have good talent, but maybe you are not that skilled in management because management skill requires time, not only study. Really, you need a lot of experience to understand what must be done and not, avoiding as many mistakes as you can. Now, if they need some kind of help, okay, are you willing to help them? And if, how do you believe you can give more value to them?
Um, Again, the short answer is absolutely yes. And I think with people who have like multi-year experience in either specific sectors or specific functions. That's where the additional help can come in. Just taking my example, the fact that I've worked across so many different roles and functions, or I have been an entrepreneur myself, like I co-founded a company in the early days. Not only can I relate to the challenges, but I can also provide perspective based on my experience. And again, depending on the kind of like functional specialization that someone has. In my case, my recent experience is business development and marketing or go to market. I am the one that can help. And I'm doing that, by the way, on the side with, startups that I have not necessarily invested in. I've started like some consulting work. And I think the breadth of my experience, the fact that I work many hats, can provide not only like, kind of like functional expertise, but also to your point, like general management expertise and understanding and navigating what are the different parts and the moving parts of the business and of the company that need to align in order to work properly. I'm not like I'm not necessarily bragging. Like there are people who might have like more experience in other sectors, but I think a well-rounded one could be really helpful for early stage founders that might lack those type of skills, especially at the beginning of their career if they're young founders.
There is a bit of talk about investing in solo founder and two, three, four founders. Uh, do you, I mean, would you invest in a solo founder?
Um, I would, as long as it goes back to the team, although in this case the team is made of like one person. I would, if I get the feeling, it's not just about like, being smart. It's not just about being visionary, like that's what I usually distinguish, right? There are some people who are visionaries. I'm not a visionary person. I'm an executor. I'm someone who can like sit next to you, and like make your ideas happen. So I think that founders need to be visionary, but they also need to be what I would say coachable, need to be humble to like, surround themselves by, if it's not team members, people who can advise them, and then eventually they can't just like, keep going on their own. So it's about finding what they're good at and then complementing those skills with someone else, whether it's like a future team member or an advisor. So I'm looking, if they're solo founders, I'm looking for that personality trait of like being open to be coachable and get advice and be humble enough to recognize that that person can't do anything, and so like getting support from someone else eventually is the right thing to do, and so they're not just stuck in their own echo chamber.
Many startups they fail, 90%, even more probably. Now, funders in their journey to try to get something done and come up with a great company, the point where many times the point where you must pivot comes, but many of them they refuse or they can't understand that if you don't pivot now, if you don't change, drastically change something in your startup, you're going to fail. So what is your advice based on experience for them here?
Specifically, you mean for pivoting or
Yeah, yeah. Accepting to pivot and do it immediately before sooner than later, otherwise it's just too late.
yeah, I mean, I'm all in favor for that. To be fair, to be entirely transparent, I haven't found yet a situation where I've invested in as an angel and I observed the team or the company to pivot. So I don't have direct experience. However, I do have some experience when I was running the internal accelerator for my company, and we were incubating ideas over the course of 12 weeks. I have seen people who started from one idea, went out, tested the market, got some answers, and needed to pivot because their original idea was not catchy. It was not being successful or well received by the market. So I'm absolutely all in favor of pivoting when the time is right and when the market is in the right place. And this goes back to my earlier point. I think a sound and strong founding team is the one that is able to pivot when the time is needed, right? Like, so they're not so stuck into their idea and they're not so like attached to that, and they're willing to make the necessary change for the company to survive, whatever the reason is. Again, market is not in a good place. Customers are not well receiving the product. I actually do have an example of a company that I started consulting with. They started from like an AI type of solution of like image generation, if you wish. And then they realized that the market was so saturated that they pivoted into image editing. So they found like more of a need there. So they use the same technology, but for a different use case, because they found out that the market was not receiving as well the original idea.
Pivoting is crucial. What I like to tell to the founders is maybe bedtime will come. Maybe you need to pivot. It can happen. But what is crucial in pivoting is cash. If you don't have cash
Mm,
sitting there, you can't pivot. I'm sorry. Because pivot requires time. If you don't have cash, you don't have income, unless you have your shareholders already supporting you or an extra round, which is doing an extra round pivoting is not that simple. It's very challenging. Can be extremely, extremely challenging for any founders. But let me ask you
it's a good point.
why. Why did you become an investor? What's the trigger here?
um, well, there are many different reasons, I would say, that for which I decided to become an investor. Um, I would say, you know, as I was saying at the beginning, I think being close to the startup world, whether as a co-founder or as a corporate innovator, if you wish, already already kept me close to this world. But I would say that there are three main reasons why I decided to become an angel investor. The first one is financial. Like people say that 10% of your portfolio should be in alternative assets. The truth is that investing in startups are like less affected by market fluctuations. And in fact, if you think about it, like the most profitable and valuable companies like Uber or Slack or Airbnb came out of the after the 2009 2008 financial crisis and recession. Now, as we said, like investing in early stage startup is very risky, but if you do enough of that and it's only a part of your portfolio, there's a good diversification. So that's the first reason. The second one is that, which is connected to this first one, is like you can have, it's not a passive investment, it's a direct investment. And so you can have, and you can support industries and founders and companies that you care about, right? So you align with your values versus investing in, an ETF fund that tracks the market. And then the third element is that you expand your expertise and your network. For me, it was like building learning blocks on top of like what I was already used to doing, right, in the corporate world. So as an example, when I became lead investor or SPV organizer for the second cohort, I started getting familiar with practice on the deal terms, on the relationship with the founders, on like how to handle investment. It was a completely new area for me. And at the same time, you do that by expanding your network and you become more familiar with maybe different industries that you were not exposed to, different type of people, different type of founders. So it's kind of like an amplified type of like learning experience that it's not just like reading on papers or reading on books, but it's really really practical because you are exercising and you're putting into practice everything that you surround yourself with.
Let's say you have three startups, almost the same, very, very close to be similar, and your valuation is 555, but you need to decide. So, what is going
Mm.
to make the difference here? I know team, it's everything, but teams is done by different people inside. So, let's say you had three very great teams, very good startup, but you can only invest in one. What really is going to trigger you is, okay, I'm going to invest in this guy because I believe there is something that comes to gut probably that drives in very early stage.
Absolutely. I mean, especially in the early stage phases of a company, you don't have a lot of data, right? Like there's no numbers. Everything is assumptions. Everything is like, and even that's why I'm also like and we can talk about if you want to cover that later, like, pitching, I have my list of do's and don'ts. Um, that's why I'm very wary when, people talk about big numbers, financial projections in the early stage. Like anything can change in the next, in following like 6 or 12 months. So it is a gut feeling. I agree with you, which goes back to my point about team, which I don't want to like repeat again, but like the gut feeling of whether the team is able to do that. But let's say these three investments, this 555, have all amazing teams. I think it's a few things. Like, number one, how you feel based on your knowledge and based on your expertise, how scalable the idea is, right? Like, how much can it grow over time versus being, versus requiring a lot of human capital, for example. How technological it can be, how technology can help scale the company versus, or in other words, how much for each dollar that it generates, the impact on cost is not proportional, but it's actually going down. So you're making more and more profits over time. Another criteria could be capital intensive. If it's a very capital intensive industry, I tend to shy away from that, because that means that you need a lot of capital. I'm talking about real estate, if it's like development, or biotech, right? Biotech companies or pharma like require so many years of capital injections before they come to that. Plus, it's a sector that I'm not familiar with, right? So I think if the idea is like very, very scalable and doesn't require a lot of capital, is interesting to me. And the last thing that I'll say is what I've noticed now recently in the conversation that I'm having with founders, because of the capital crunch that happened in the last couple of years and how valuation were out of control, like maybe a couple of years ago. Some founders are trying to shy away from like getting VC money. So sure, family and friends or strategic angels for the initial investment. But if they're able to get to profitability and by bootstrapping it, or like without having that kind of capital injections, I'm all for that, because we have seen funds like dictating the terms, growth at all costs, and then when you get to a point where you don't have capital to keep investing in that and you're not profitable, the company fails. So I think that is very, very important for founders to keep in mind if they can do that in a very early stage. So out of these three companies, there is one that has that path to profitability early on. I'm going for that. I don't know what your view is on that.
Scaling for a startup, it's all. So of course, if all the factors are the same, they neutralize each other. You need to find something that outstanding, right? So scaling for sure is what matters the most. And considering that all these founders are capable to scale, if you must have the business and the market to scale. So that's true. If you're not scaling, you can have any great idea, but numbers in the end of the day, in 3-5 years, must pay, which means you must grow enough to grow evaluation. If you take the venture capital, because you are right, not all startups are mentioned to be founded by venture capitalists, because maybe you are not for that kind of growth. You can grow 20% a month, no, in a year. Many startups that grow in a year in venture capital is not even considerable. So it's a different story.
Mm-hmm.
So this is why I try to do this talk as well, to make funds understanding that you don't need to go, as you said before,
Mm-hmm.
to venture capital. Friend and family, bootstrapping. If you have a decent business model, you can make money even after a month. Venture capital is more for hyperbolic growth, when you make losses every year in order to acquire market share. And this is what venture capital is. And now it's not that anymore, because after they need to exit, they go to the IPO, the stock market said, you know what, what's the point to buy you if you only make losses? And that's why we work failed. And now Newman is trying to buy back.
Absolutely.
That's the reality. But you're completely right. Let's go to pitch. Now, if a funder comes to you, how the pitch, how a pitch can really attract you and say, I'm not going to invest, because you're not going to invest after one pitch. But let me follow up with these guys, because maybe there is something good behind this pitch.
Absolutely. So, after looking at tens, if not hundreds, of like pitch decks between my, corporate innovation experience and an angel, and like even attending your event at being a judge for pitches a couple of weeks ago. I kind of like found I developed like an eye for pitch decks, or at least what kind of like resonates with me. The first one is that I see a lot of like people still not doing is the beginning, right? Like the beginning of like problem and solution is like so important to me, because you're not, what I say is that you need to convey the message that you don't have vitamins. You're not providing vitamins. You're providing painkillers. Like you have a pain and then you have a solution to that pain. It's not just like a nice to have, like it's a must have, right? And so if they do that early on in the pitch, that is already a good sign for me. And even better, like give some context to why people should care about the problem that you're solving. Sometimes people use personal storytelling, which I think is like great. Not everybody has that, but like obviously adding an element of like personal story, I think is like really attractive to me. The second point is share what is your secret sauce and why you're unique or different from the competitors. And it's not just about the competition slide. I want to understand how you're doing what you're doing differently, especially in an area or in a time, in an era or in a time where there's like so many startups. Like the market is so crowded. Take, for example, AI. Like, how are you able to stand out from your competition and make me feel that there is something there that I want to like learn more about at least and dig deeper into. The third element I would say is traction. Now, we just said earlier that traction is very hard in early stages, right? Like traction, what I mean by traction is not necessarily like customers. I mean, if you have customers, it's great, but a sign that customers are willing to pay for your product service. Like show me that you went out and interviewed like hundreds of people, thousands of people. Like show me that there is something there that customers want and they're willing to pay for that. And then another thing that I see that people don't do a lot of is put the ask. Put the ask at the end. What are you asking? How much money are you asking? And what are you planning to use those funds for? Sometimes people just put the ask without the use of funds. And for me, it's a turnoff. Like I want to understand, do you need that money to like put it all in marketing because you need to capture market share? Do you need to hire the team because like, it's a very technological product and you need to have the engineers? I want to understand what is what is standing from like this founding round to the next one and how you're planning to get there, to get to that next milestone by using those funds. And then I also have a list of like don'ts, but we can do that later.
What's suggested to funders? How funders should approach angels, venture capitalists, investors as a whole?
So I think kind of like confirming everything that you've said, meaning that the most important thing is putting yourself out there. And putting yourself out there means networking, attending events, and even just like gathering feedback and information. I, for example, got to a point, I went to this like startup pitch event last week here in Manhattan. I realized that after like a couple of years into the startup scene, I am able to make those connections. And so, and provide warm intros. And so I think that founders should actively seek as much as possible investors, but without necessarily asking for money, but asking for help. Help in the sense of like, can I grab 30 minutes of your time for you to provide your advice? Or would you be able to like look at my pitch deck? They should be like out there looking for support and not just financial support. One thing, for example, that is a really a turn off for me when it comes to LinkedIn, for example, is that sometimes founders don't do enough research when they don't do enough homework. Like they send us like cold messages, and maybe they're helped by technology, but for me, the conversion, and I made a LinkedIn post about that, the conversion on those messages is like so low. I know they're casting a wide net, but if I've invested in, as I said, food tech and mental health and sustainability, and they come with a real estate investment or like with a deep tech investment, I'm like, have you even looked at my profile? Like, why do you think, I am the best fit? And so for me, it's a turnout. So the other piece of advice that I give to founders is to do their homework. not just like, go and try to get money for everybody from everybody. Like try to find a good fit in terms of like who can support you, not just financially, but also with their brain and network capital.
I mean, sometimes it's required to have an intellectual property, right? An IP protected, especially when it comes to hardware. Software, not that much. Uh,
Mm-hmm.
do you invest in startup that must have an IP and don't have an IP? Not me. I understand protecting an IP is pretty expensive. So at the very beginning, maybe you are not there yet, but having the property of the IP makes a lot of sense.
It does. For me, it's almost like a secondary thought, meaning that it's not like the core idea or the core mission behind the idea to like protect the IP, unless to your point is like a very specific technology or product. Both the companies that I have invested in, the direct investments, have decided to patent their technology or their product as an afterthought, meaning that they first developed the concept, the idea, the painkiller, the solution to the problem. And then they're like, in order to build a moat, so in order to like, protect my idea from being replicated by someone else, I'm gonna like submit patents and or request for patents and patent my technology, right? But it's not like the immediate need of the company. It's more of like, now that I validated this need from the market, how can I further protect my idea? Which I always think it's about implementation. It's not about the idea. Founders that send you like an NDA, oh, like I don't want my idea to go out there and be stolen. I think it's like not very smart. It's all about how you execute on that idea. But then if the need is there to like protect even further your concept, your product, I understand why people do it. But it's not something that I'm like, okay, I want founders like to think about that immediately. Does that make sense?
Of course, of course. Let's close with the future. Now, where do you see the money be deployed in 2024? We can't talk 2025. It's just too far away. In 2024, I mean, let's don't talk about AI because everything's AI. I think the last 200 pitch I've seen in 6 months probably is people coming to pitch in our live show. It's me. There is no way there is no AI involved for everything. Which is, as I say, told the funders, you actually don't need AI now. What's the point to mention AI? You are not even using AI. You mentioned something that is not even there, and you don't even need.
Mm-hmm.
But where do you see taking away AI? The sectors that actually are attracting money, where money will flow this year. Impact, for example. What else?
Well, impact investment is definitely something that is resonating more and more with investors. I mean, not just talking about myself. I am noticing now that I've invested in one company. Well, I guess both of them are connected to climate because the food tech company is it's a vegan sashimi, so it has a positive impact on the environment, and the other one is like sustainable packaging. I am seeing now that I'm closer to this world. I'm seeing a lot of companies popping up in this field, and as a consequence, a lot of money being poured into that. Now, climate is a very broad definition. It could be renewable energies. It could be like services that like allow for those technologies to flourish. Like it's very broad. It's very complicated. But I'm seeing a lot of like companies not just getting funding, but like growing, hiring people. So I feel like this is a trend that is gonna be here to stay because mostly the future generations or the current generation care about it, and as a consequence, investors, not all of them, but some of the investors, also support the cause. I think B2B SaaS is still something that is always going to be there. It's a very scalable when done right. It's a very scalable market, or it's a very scalable type of product or industry. So there's always going to be, I think, a need for companies for that type of like support and softwares. And what I am finding interesting is not necessarily like a sector, but it's kind of like a need. in a time where companies have been struggling, whether to raise funds to grow, I have found that companies that solve other people's problems, whether it's consumers or companies, are the most successful ones. So instead of like going to a company or selling your product as something that that organization needs to spend in to like become better or to grow, I've seen a lot of success in cost cutting company. If your technology allows me to like reduce my costs, instead of like needing to spend more to get to that level of growth, I think that's a great need that is being solved by one of those companies. So if you're a company that solves for that need, I think you're gonna get like it's a very straightforward case that you're solving for, and you're gonna probably get some good funding.
I totally agree. I mean, the difference when you launch a company is very much the problem. You're right. If the problem is seriously there is a problem. A PayPal, it's absolutely an unbelievable story about problems. Problems. It was not even a problem. Nobody thought was there. And they got millions. This guy, they didn't even know how to handle all the all the emails, all the back office was absolutely a nightmare for them. But yes, I mean, you take off immediately if the problem is there. You have the problem to respond to the problem and not to push. Exactly the opposite. You're very right. Let me close with what can be any advice you can give to funders because that's a podcast done for them. As an angel,
Mm-hmm.
any that you believe can be helpful for them.
What I have observed as the kind of like most successful strategy in founders that I've come across in this past few years is, you know, I think it goes back to what I was saying earlier when you asked me the question about the solopreneurs. Like I think be humble, stay humble, be willing to be supported, help, change your idea when the time is right to pivot. Um, Go out and like look for help and support, not only by investors, but also by other founders. Like join communities. I've seen this a lot actually. I've joined a couple myself. Like having a group of like-minded people around you that can provide support and advice and help is really really important. So like put yourself out there in the most humble way, and welcome welcome advice, welcome support, just like on your journey, so that you're going to be able to kind of like absorb as much as you can from other people who might have been there, or can really like give you some good support.
Matteo, thank you so much for coming to the Investor Talk series. It's been a very great pleasure for me. I hope to see you again as a investor guest in our coming pitch events. But for today, thank you so much.
Thank you so much, Max, for having me. This was really fun, and yeah, you'll see me around soon. Another pitch competition.
I look forward. Thank you.